Canada's banking regulator is making changes that could have an impact on real estate markets across Canada. The Office of the Superintendent of Financial Institutions, also known as OSFI, has reportedly introduced a new mortgage test to ensure that lenders are not taking on too many highly indebted borrowers. In this video, I'm going to give you the rundown on what we know so far, how this might affect buyers, sellers, and the real estate market in general, and some of my own questions and concerns that I had while reading about these changes. My name is Jessie McLellan, and I'm a realtor here in Oshawa, Ontario with the Lisa Abbott team, and I make videos to keep you informed about everything that's happening in our real estate market, especially in Durham region and the GTA. If that's something you're interested in, then please hit that like button and subscribe to the channel if you'd like to see more. I'm going to do my best to explain and summarize what I've read so far. This isn't coming into effect until the first quarter of next year, so there will likely be more information that trickles out between now and then that might end up answering some of the questions that I have and questions that you may have too. Of course, when the time comes, you're definitely going to want to talk to your mortgage broker or agent because they're going to be the ones who are going to be able to guide you best. But first, we're going to start off with what exactly are these changes. OSFI has said that they are limiting the number of mortgage borrowers with highly leveraged loans that banks can have in their portfolio. This cap, when implemented, would restrict the number of mortgages a bank can lend on that are larger than 4.5 times a borrower's annual income. This is not a test at an individual level like the stress test, but rather a cap that's put on the banks and their entire portfolio. However, it'll be interesting to see how it does impact the process at the individual level. This change will come into effect in the first quarter of 2025 and would only apply to uninsured mortgages. Mortgage insurance is required on loans where the purchaser is putting less than 20% down on the property, and there are already a lot of restrictions for buyers with insured mortgages, but we'll come back to that later in the video. The Financial Post has done an article on these changes, and I thought they answered some very good questions, so I'm going to go through some parts of that with you. So why is this happening? The change is one of a series of expected adjustments to mortgage guidelines that have been under discussion since last year. OSFI says that the new portfolio test is intended to prevent the buildup of highly leveraged loans during low interest rate periods. The regulator is particularly concerned about loans that are more than 4.5 times borrower income because they raise the probability of borrower default and increase the lender's potential losses. As demonstrated by the prolonged period of low interest rates before steep increases beginning in the spring of 2022, such debt may be manageable in a low-rate environment but becomes much more challenging for borrowers and their financial institutions when rates rise. The first thing that was mentioned was that this was just one piece of a series of expected adjustments to mortgage guidelines that have been under discussion, so it'll be interesting to see if we see other guidelines roll out in the future. But I'd like to show you exactly what they're talking about when they mention concerns about highly leveraged loans building up during low interest rate periods. This is a graph that shows the share of new mortgages with a loan-to-income ratio above 450%. The blue line is the uninsured mortgages, which is what will be impacted, and the yellow line is insured mortgages. The section I've highlighted here is when mortgage rates dropped from 1.75% to 0.25% in 2020. And now this picture is when mortgage rates started increasing to where we are today. Before the rate decrease, the share of new uninsured mortgages was 17.7%, and at the peak just before rates increased, it reached 26.6%. So over a quarter of new uninsured mortgages were highly leveraged and at higher risk, especially when rates increase. Once interest rates start to come down, the stress tests for individual borrowers will carry a lower qualifying rate, meaning that borrowers will qualify for a larger mortgage, and that means loan-to-income ratios will go up, and with talks of rates potentially coming down later this year or in the near future, OSFI wants to prevent banks from taking on a large amount of these high-risk uninsured mortgages. It's less of an issue for insured mortgages because they already have such strict restrictions on debt ratio, on not allowing rentals, no properties over $1 million, and they pay a premium to insure their mortgage, so if they default, the insurance covers it and the bank isn't out. But an uninsured mortgage does not have the protection. That period I showed you where the number of high ratio mortgages spiked, home prices also peaked during that same time, as many of you know. So if the borrowers who purchased during that time stopped making payments and the bank took over the property, the bank would be at risk of serious loss because the property values have decreased since they were purchased. OSFI is hoping to prevent those high-risk loans from building up again if and when those interest rates come back down. Now quickly back to the article. When asked about whether this applies to borrowers like the current stress test, mortgage strategist Robert McLellan said there will be no prohibition on an individual taking on a mortgage if the loan exceeds their income by more than 4.5 times. Even with the new test, banks could allow an individual borrower to exceed the cap so long as the entire portfolio averaged 4.5 times or less. And when it comes to whether all banks will be bound by the same cap, apparently OSFI was considering a 25% limit to the number of loans that can exceed the LTI threshold of 4.5 times for all banks, but instead they will monitor the banks individually and apply the test based on each institution's business model. But remember that even at the peak level of new uninsured mortgages with a loan-to-income ratio above 450%, which was in Q1 of 2022, it was only at 26.6%. The rest of the article has some great information, so I'll post a link in the description if you'd like to check it out. After reading through what was available, I saw a lot of good questions brought up online, and I had some myself, so I'll run through a few of them. Does this encourage people to use insured mortgages and to put less money down? As a knee-jerk reaction, maybe, but in my opinion, not really. As I mentioned earlier, the restrictions for insured mortgages are already really high, and mortgage insurance is not cheap, so it's not going to be as simple as a buyer putting down 19% instead of 20% or something like that to get a higher qualification. What's more likely to happen, in my opinion, is for buyers to be pushed towards exploring alternative lending. These new guidelines would not apply to private or B lenders. Those are controlled at the provincial level while this is being applied federally. So alternative lending options like credit unions and smaller banks or private lenders could be what more home buyers and investors turn to if they're unable to secure the lending they want or need through one of the big banks, especially in higher priced markets like Vancouver and Toronto. I would also be curious to see how this would impact people who are self-employed, as their income and how they're approved for mortgages can be much more complex. Another concern I have is that we have something like 70% of mortgages coming up for renewal over the next 2 years. Now, I know there'll be many borrowers out there who won't exceed a loan of 4.5 times the income, especially if they have already paid down a chunk of their mortgage and renewed, which will bring down the overall ratio applied to a bank's portfolio and allow them to make more high leverage loans. But while this doesn't affect renewals directly, it could potentially impact homeowners who are looking to switch lenders while looking for better rates. Like the stress test currently does, this could prevent people from switching and shopping rates because they cannot requalify, and so they're forced to just take whatever renewal rate their current lender is offering. There's also the concern around mortgage fraud. Over the last few years, we've seen that concern grow and receive more attention in the media, and although this guideline would apply to the bank's portfolio and not the individual, I have to imagine it's going to result in some buyers receiving lower pre-approvals than they may have previously, and I can see how that could lead to an increase in mortgage fraud in the future. I saw a lot of questions and speculation online about how this may affect investors or homeowners that own secondary properties like cottages, and it doesn't seem like this would impact people who currently own multiple properties unless they decide to refinance or look at switching lenders. But for future investors, depending on how these guidelines play out and what the limit is from the banks, this could absolutely have an impact on them. We've seen from recent history that though buyers are smart and conscientious, they will generally go towards whatever lender or mortgage product will allow them to borrow the most amount of money, especially in high-priced markets when getting in is already so tough, in order to gain a small advantage in the market. We saw this when you could lock in a historically low fixed rate for a long time. Buyers still opted for variable rates because it allowed them to qualify for more, even though there was nowhere for those rates to go but up. So I wouldn't be surprised to see some affected buyers or investors pivot to other lending options if the bigger banks' mortgage products become less competitive or accessible than the private or B lending side of things. And my final thought about this is, how might this affect new construction? Over the last year or two, I've seen a number of articles come up that talk about a very large percentage of pre-construction homes, especially pre-construction condos, being bought by investors. So if this does end up impacting investors significantly and maybe the private and B lenders don't end up with much better offerings than the banks, what impact could this have on pre-construction? Could we see projects being canceled because investors are having difficulty getting funded? As much as I would love to see more families owning homes, if investors are the ones primarily funding those projects, how do they get completed if the developer loses a large chunk of its customer base? Unfortunately, it does not mean that families will just magically be able to afford them overnight, but maybe we could see some builders pivot and a shift to how these buildings are being planned. Maybe we would start seeing more 2 and 3 bedroom condos being built instead of buildings that are mainly geared towards investors and cramming hundreds of small bachelor units into each building. But let me know your thoughts on it. I would love to know your questions and concerns as well, and I'll keep you up to date on this moving forward. So if you enjoyed this video and would like to keep up with everything happening in our local real estate market, then subscribe to the channel. If you have any questions for me about buying or selling a home in Durham region or the GTA, or even just a question about our market, you can use the link in the description to book a call with me at a time that works best for you. I hope you found this video helpful. Thank you so much for watching until the end, and I'll see you in the next one. Bye!